Hi everyone. Miserable weather out there. Good luck to all of you who are traveling, including my mother-in-law, whose flight to Mexico from Washington yesterday ended up landing in Baton Rouge. So I know there's a lot of people suffering out there, and I hope this weather works out for you okay. A bit nervous about power cuts actually, but New York, generally speaking, hasn't been too bad for that kind of thing. Touch wood. Boom, boom. Okay, I thought just very briefly I would show you my Christmas present to myself, which I'm extremely happy with. And you know, here it is. It's absolutely beautiful. It's the British Pioneer, and if you're worried about me celebrating the oil industry when I should be denigrating it, this is actually the decommissioned British Pioneer, which is just an absolutely fabulous model. I've always wanted one, and I thought, buy myself a Christmas present. Hey, $25,000 isn't too much to spend. It was $600 actually. I mean, it's a lot. It's an extravagance, but it's absolutely beautiful. Anyway, it's not entirely what I wanted to talk about. It's actually refining, because we ran our refining conference last week, and then after 6 or 7 companies last week, we've rounded out with Phillips Petroleum. So we had essentially, I think, 7 CEOs talking about refining, and you're just reminded of what a great sector this has become in terms of, the companies were really the first to take their medicine in oil 10 years ago now, and ultimately have become very focused on operational excellence, on running the refinery safely, and ultimately on constraining capex within that context and returning as much cash as they can to shareholders. And so when we look at the cash return of the group, which we sort of think is the only investment case for oils, ultimately, it is ultimately the end of the oil age, or at least we're not going to see a huge amount more growth, then operational excellence, cutting costs and returning cash to shareholders is the best way forward. And almost the entire refining group now has a 10% implied cash return to shareholders this year coming up, and many of them have even greater plans for the year after. A couple of the leading names like Marathon Petroleum have been long-standing favorites of ours. The most interesting one that could change at the margin is probably Phillips 66, which now has the activist Elliott Management involved. They, of course, were hugely instrumental in the win that has been Marathon Petroleum, and all of these companies are essentially doing very well. Their outlook for this year is pretty positive. The distillate market globally remains tight, and I continue to think that the situation in Russia is steadily deteriorating. And as a result, the tightness in European energy markets, particularly in distillate in the case of the refiners, but also in the expense of natural gas relative to the US, is going to remain a major benefit to US refiners. And as I say, the entire group across the board essentially combines dividend and buyback to more than 10% return, with the single exception of Par Petroleum, which in itself is a very interesting play. Less cash return, but ultimately the best performing oil stock actually of 2023, with a very good outlook going forward. And one of the mega themes, for those of you worried about me buying myself a decommissioned oil tanker model, has been clearly sustainable aviation fuel, which we think will be the next big thing in refining, which is very much in the post. In fact, they've overinvested in renewable diesel, and that is one of the negatives alongside petchems. But the business of refining itself has consolidated. The companies have much better managements, much better strategies, and there's just less of them. And as a result, the outlook for refining this year is good, and we continue to like the group. As I said, a couple of them, Marathon is an obvious winner just from the scale of its buyback. Phillips has excellent change at the margin amongst the big guys. The one company we were missing actually was Valero, but we'll be doing a meeting with them in early February, and we'll update on Valero in due course. But essentially all the other names, whether it's PBF, which looks very cheap, whether it's Delek, which has potential, although it's difficult to really see it realized anytime soon, but has potential to restructure, whether it's Coffeyville, which is just a very well-positioned refiner. All of them essentially, Dyno, where we were very impressed with the new CEO, Tim Go. All of them essentially did a great job at the refining conference, and we're pretty positive on the group. And of course, as long as you're positive distillate, you tend to think that a lot of things that went right for oil supply in 2023 probably won't be replicated in 2024. And in fact, we wrote about that a lot of the wild members of OPEC, if you want, the Libyas, the Nigerias, Iraq, all of them actually had very strong, essentially 2023s. And almost as soon as we had written that, Libya has had major issues. Of course, additionally, the potential for more outages through the Red Sea and so on will continue to make international crudes more expensive than US crudes. And when you combine that with the structural cheapness of US natural gas, notwithstanding the weather right now, you're seeing US natural gas, struggling towards $3.50 per MMBTU, while it's more like $13.50 per MMBTU in Europe. All of these things are structural benefits to the US refiners. Some of the negatives, well, this weather could upset the industry. So you could see, in the case of certain, very weather-affected refineries suffering here in the very short term. But ultimately, that tends to serve to increase margins. And as I said, the company managements and the operations are so strong now that they tend to deal with these problems really quite well. So we're essentially positive on the group. The group is a hiding place, and I think it's more interesting to find reasons to be bullish in oil and the E&Ps. And what we're arguing essentially is, with the market beginning of 2023 having been very bullish, really quite bullish on oil and really quite bearish on the market, this is as 22 ended and as 23 started. After a very bad year for the market in 2022, everyone was bearish, the S&P coming into 2023. Bullish oil, and of course, and bearish on the potential for inflation to stay high. What you actually got was a rollover in inflation, a ripping S&P, and a bad year for oils. I find it interesting that as we start 2024, people are again arguing for more of the same. So we ended 2022 and people thought this would get a continuation. We didn't, we got a reversal. Now, of course, we end 23 into 24 and people are arguing for a continuation, and you're thinking, this is probably going to be a reversal. And I think that the reversal against consensus would be that people are basically underweight oil, certainly underweight the commodity. And the potential is there, notwithstanding a little bit of a shock to the market. It seems to be a shock. I don't think it was a great shock to us that Saudi would cut its official selling prices, which just goes straight through to the oil price. The fact is that that impact has left oil, Brent, trading at $75 a barrel, which is a good price. And with, as I said, tightness in global distillate, with a lot of upheaval globally, the potential is for the oil price to surprise somewhat to the upside. You can't get overexcited because of the spare capacity out there, particularly in Saudi, and the potential for the Saudis to increase production if it's needed, which probably caps us at 95. But the potential for us to go higher from here, given that January as a seasonal low, is quite clear. And of course, can the market keep going up forever? We've highlighted that what we call the Monopoly 7, what people call the Magnificent 7, had a 40% multiple expansion in 2023. I'm not sure how you can be bullish and expect another 40% multiple expansion from the Magnificent 7. I guess it could happen, but it just seems like, given the market caps, it's an awful lot to ask for. So with oil, in our perception, being pretty much the least liked sector of the market, we're more inclined to like the oils, like the refiners, and be cynical about the outlook for the wider market in 2024. Have a great day.